If you have been checking your mutual fund portfolio lately, chances are you have seen more red than green. And naturally, the question is, why is everything falling at the same time? Because this doesn't feel like a normal correction. There are multiple factors hitting the market together. Global tensions, oil price concerns, foreign investor outflows, and even some very important domestic triggers. And one of those domestic triggers, which most investors are not even paying attention, is something I call the HDFC effect. Let's break this down step by step. Hello investors and welcome back to the Equitymaster channel. I'm Mitali Doke, research analyst here to simplify mutual fund investing and guide you on a smarter wealth creation journey. First is the geopolitical tension and the oil shock transmission. One of the biggest triggers right now is geopolitical tension in the Middle East. India depends heavily on oil imports. So whenever there is uncertainty in oil supply, crude oil prices react immediately. Now markets don't just react to actual events, they react to expectations. Even the fear of supply disruption pushes oil prices up, and this creates a chain reaction. Higher crude, higher inflation, pressure on consumption, impact on companies' earnings, and when earnings expectations fall, stock prices adjust, and mutual fund NAVs fall along with them. Second is a shift towards safe haven assets. At the same time, global investors are becoming cautious. Money is moving out of equities into low-risk assets like gold and silver. This creates a risk-off environment. So even fundamentally strong stocks may correct not because something is wrong, but because liquidity is shifting. And mutual funds reflect this movement. Third is the global trade and growth concerns. There are also signals of tighter global trade policies, especially from the US. This creates uncertainty around global growth. Sectors like IT, pharma, and manufacturing, which are globally linked, start seeing pressure in valuations. And mutual funds with exposure to these sectors naturally see a dip. Fourth is liquidity tightening and FII behavior. Now, one of the biggest drivers of market, liquidity, is also changing. Foreign institutional investors are becoming cautious. They are reallocating capital to developed markets where returns are more predictable and also factoring in currency risk. So when FIIs sell, especially in large cap stocks, markets react quickly. And since large cap stocks form a big part of mutual fund portfolios, this selling pressure directly impacts your returns. Fifth is the HDFC effect, why your portfolio feels heavier than it is. Now this is very important and often overlooked. Even if you have invested in multiple mutual funds, your portfolio may not be as diversified as you think. Because many funds hold the same large cap stocks, and one of the biggest examples is HDFC Bank. HDFC Bank is one of the most widely held stocks across large cap and flexi cap mutual funds. It also has a significant weight in benchmark indices. Now recently, the stock has gone through a phase of subdued performance. After its merger with HDFC Limited, the bank has been adjusting its balance sheet, especially dealing with deposit growth challenges and margin pressures. This has led to a phase of normalization in performance rather than the strong growth investors were used to. On top of that, development like the resignation of Chairman Antanu Chakraborty have added a layer of short-term uncertainty in the market narrative. Now here's the key point. When a stock like HDFC Bank, which is present across so many mutual funds, underperforms, it doesn't impact just one fund, it impacts multiple funds at the same time. So even if you're holding 4 to 5 different mutual funds, your portfolio may still fall together. This is what we call portfolio concentration risk. And this is exactly why your portfolio might feel heavier on the downside than expected. Sixth, the psychological layer, fear and investor behavior. Now let's talk about something equally important, investor psychology. Markets are not just driven by numbers, they are driven by sentiment. Constant news around war, oil prices, falling markets, and all of this creates fear. And when investors see their portfolio values going down, they tend to react emotionally. This leads to panic selling, often at the worst possible time. And ironically, this is when long-term opportunities start building. Why investors should stay invested? Now the big question, what should you do? First, understand this clearly. This is not a structural breakdown. This is a recalibration phase where markets are adjusting to new information. If you are investing through SIPs, this phase could actually benefit you. Low markets means better accumulation. Trying to exit now often means missing the recovery, and recoveries usually begin when sentiment is still negative. The larger perspective here is what we are seeing today is not because of one single reason. It is a combination of global geopolitical risk, oil price concerns, liquidity tightening, sector specific and stock specific pressures like the HDFC Bank, and investor sentiment. Now, to conclude, so the next time your portfolio is in red, don't just look at numbers, understand the reason behind it. Because smart investors don't react to short term noise, they stay focused on long term strategy. And often it's these uncertain phases that create the foundation for future returns. So if you like this video, hit the subscribe button and follow us for more interesting investment related videos. Signing off for now, happy investing. The securities quoted are for illustration only and are not recommendatory. Past performance is not an indicator of future returns. This video is for information purpose and does not constitute any kind of investment advice or a recommendation to buy, hold, sell a fund. Returns mentioned herein are in no way a guarantee or a promise of future returns. As an investor, you need to pick the right fund to meet your financial goals. If you are not sure about your risk appetite, do consult your investment consultant or advisor.